Howdy there, folks. Welcome into the four videos for me to react to, give my opinions and perspectives on in this one here today. First one up here. Now's the time to get ready to attack the weakness in the market, says Canaccord. Tony Dwyer, looking forward to getting that one. Evercore founder, I think he's been around a little while. Hard for markets to move higher until there's more clarity on short-term headwinds. Looking forward to getting in that one. The fiscal spending has been out of control. Looking forward to reacting to that one. That should be an interesting one. And then last up here, Amazon's major investment of mine. Might be a major investment for some of you guys out there. Certainly if you own any index funds, Amazon definitely is. You might also own Amazon stock straight up. So I want to hear what Amazon's up to here in regards to the AI arms race, a $4 billion investment. So yeah, looking forward to getting that one. Appreciate everybody joining me as always. Thanks so much, folks. Happy Monday. It's about 10 a.m. I'm recording this. It's about 77 degrees outside here in Vegas. So absolutely gorgeous. I appreciate y'all being subscribed to the channel. We are at a new all-time high. So appreciate each and every one of you.
It's great to have you. You have been cautious, I would argue, for a good portion of the year. Is there a sense that this market is sort of moving your way?
Well, it's kind of the good portion of the last year and a half. Carl, as you know, I'm kind of known as the perma bull, and it's been the opposite for the last year and a half. And it's one really simple reason, and it's higher rates. So, earlier Mike talked about the corporate credit market holding in great. And people like me love to come on and talk about the study of how spreads and corporate spreads are doing well, and it's not indicative of any kind of real slowdown. But somebody better tell a CFO who's now raising money in high yield at 8 3/4 that it's okay because the spreads are narrow when it's up from 3 3/4 at the end of 21.
Right. So I guess the point, Tony, is that financial conditions are tightening, even if spreads are okay, they're tame, and if you're a corporate credit buyer, you can hedge it out in treasuries and you're still happy.
Yeah, Mike's, we've done this a long time. Every once in a while, we got to throw a little bit of common sense in here. I run a household, right? It's going to cost me, my mortgage expense would be so much higher if I had to take out a mortgage now. There's one thing, whether it's a soft landing, a no landing, a hard landing, whatever kind of landing you want, there's always a catalyst that takes you out the other side of it. And it's an improved outlook for money. That improved outlook for money always comes from lower treasury rates, lower mortgage rates, and lower corporate rates. And right now, as you know, we're making a cycle high for all of them. But to your point earlier, Mike, it's a really important point. Yeah, the S&P is down 6%. The equal weighted S&P is flat for the year, and the average stock in the NYSE is down 29.3%. So the idea that people like me are going to come on here and say, now run for the hills because the market's starting to weaken, it's already been extraordinarily weak. So what I think you want to do is look for
100%. You guys want to know something shocking? I mean, absolutely shocking. Okay, I put last night I prepped up this video for the private stock group, right? And I'm basically in this video, I'm going through all these different stocks that are at either decade lows or multi-year lows, and basically kind of just from the frame point of like how I think about these things, how I look into them, and whatnot, right? The amount of what would be seen as extremely high quality brand name companies that have multi-year lows or multi-decade lows right now is simply shocking, folks. I mean, it is extraordinary how many of them I was going through and I was like, okay, this is enough. I've covered enough of them. Like, I could have kept going. I could have kept going for all night long. Like in terms of just another company. It was not hard to find. Super high quality brand name companies that if I said to people, would be like, oh, I know that company. And that are just at 5-year lows, 10-year lows, 15-year lows, 20-year lows. It's insane.
And bad news becomes bad news, and be ready to attack that kind of weakness. And we're getting closer to that point.
I mean, it does seem, Tony, like the trend is to be more negative. You've got strikes, you've got a potential shutdown, you've got a student loan resumption, the payments resuming. I mean, it just seems like there's not a lot of options to be real positive, even if each one of those doesn't have a super significant impact overall put together. It doesn't feel great for sentiment.
That's really, I think, Courtney, that's exactly right. It doesn't feel great. So if you talk to somebody that has student debt, they haven't had to start paying it yet. But if you ask them if they've adjusted their budget on the fear of paying it, They have. And their credit card rates all those things are there. But that's why the average stock's down 29% from its 52-week high. More than half, almost 55%, according to my friends at Ned Davis, of NYSE stocks are down more than 20%. So some of that is going to be discounted. There's really three phrases of this game as you talk about economic weakness. There's when good news is bad news because it means a tighter Fed. We got that in 2022. Then you get good news, or bad news is good news because it means the Fed's going to stop. We were in that into the summer of this year where the market had rallied over 20% off the low. But then you ultimately have to get, unless there's a dramatic, significant, and sustainable improvement in those three areas of credit, you ultimately got to get into that bad news is bad news. And that's when you want to look to take advantage of the opportunity. So, Gordy, going back to what Carl suggested, that I've been defensive for a while, yeah, we call it light and tight. We want extra cash, not extraordinarily defensive, because we want to be in a position to take advantage of a whoosh or some kind of economically fear-based swoon that's likely to come when you're having, historically high margins. Expectations for earnings, I think, for next year are out of whack, too high. And the earnings yield in the S&P 500 is roughly equivalent to a risk-free rate. That's when you want to get prepared to attack the market, not to actually just jump right in.
And then, Tony, I'm going to make a counterpoint.
So he brings up a great point there, right? Last year, if you got good news, it was really seen as bad news. And what does that mean? Okay, let me explain that to everybody watching this in case anybody doesn't understand what that means. Basically, last year, if you got some good economic data, people looked at that as actually bad news. And the reason was, obviously, the Fed was raising rates like insane, clearly, right? And so a lot of people are like, if you keep getting good economic news, that means the Fed just has to go higher, right? This year, if you get bad news, like let's say some economic data is weak, whatever it is, manufacturing, whatever economic data you want to look at, okay? If you get that and it comes in kind of weak, people look at that as, okay, this is good news because that means the Fed's likely done. If you continue to get, really hot economic activity, right, and CPI is too high, PPI is too high, then everybody looks at it and they say, oh my gosh, the Fed has to keep going higher, right? So which would be seen as kind of bad news. Now, at some point in time, like he said, you get into a market where bad news is actually bad news and good news is actually good news. And that could be more of the market story for 2024, to be quite honest, where if you get bad economic data, the market looks at that as bad, like, oh boy, earnings are going to tank. And if you get good economic data, then people get really excited. That's probably the story for 2024. It's just, it was a different story in 2022. It was a different story in 2023. And in 2024, bad news will be bad news and good news will be good news in 2024.
That I just asked if we could just play a soundbite from Neil Kashkari when he spoke on Friday about how consumers really have remained resilient. Take a listen.
I would have thought with 500 basis points or 525 basis points of interest rate increases, we would have slammed the brakes on consumer spending, and it has not slammed the brakes on consumer spending. It continues to exceed expectations.
So then how do you account for that, right? All of these sort of negative pressures, negative sentiment, yet consumers are still out there spending, even if consumer discretionary stocks had a really bad week last week.
Well, they've had a really bad time outside of the biggest ones. But I would suggest that the Fed is going by bad data. Get this one. So we did a study. We got the idea from Ned Davis, but we went back and we looked on the BLS website. You can find something called the initiation survey rate. That's when the Fed sends out data to payroll. For the payroll number we get every month. The initial response rate pre-pandemic was somewhere north of 65%. So they send out the survey, the business responds, 65% of the businesses respond. After the pandemic took place, that's dropped into the low 30s. It's been as low as 29%. So the Fed is going by very inaccurate data on their initial take. And I think that happens in the household survey that comes from the Census Bureau. So my whole point of this is we're kind of in a microwave market and a slow cooker economy. It takes a while. But people like me come on every day. You have 50 guests talking about how what the consumer's doing. When we look back, we're going to say, oh, yeah, rates went up to over 5%. consumer credit was weakening and corporate rates and mortgage rates stayed high, yeah, that's why things got hit. So I think, again, Courtney, the really most important point is it's already hit so many stocks. The Russell 2000 has been smoked. Now's not the time to start getting nervous. I think now is the time, as bad news becomes bad news and gets priced in, that you want to look to be more aggressive in those areas that are early cycle stocks. It's just a little bit too early yet.
Yeah.
Good stuff, Tony. Appreciate that very much. And we'll
so
see.
Definitely agree in terms of, you really have to take advantage of every dip you kind of see for this next, I would say 6 to 12 months, to be honest. And the reason being is even if the Fed lags catch up in 2024 and, it really hits the economy, just understand the stock market and stocks bottom way before. And I got to say, this market seems to be, usually I kind of think of the market being 6 to 9 months ahead. It seems like the market's almost pushing 9 to 12 months ahead. And so you got to understand, when you see unemployment rising, you see the economy getting worse, you got to understand, like, stocks could have already bottomed by that time or be in a bottoming phase and actually already start an uptrend way before you ever start to feel good about the economy again or good about earnings or anything like that, okay? The market's playing way ahead in this game. That's why, look at the restaurant stocks. These stocks are getting obliterated over this past several months, right? And yet the restaurants are still packed as can be. But basically the market's telling you that there's going to be a restaurant slowdown, probably in the first half of 2024. That's basically what the market's saying. And so they're trying to get ahead of that, right? And so maybe we'll see a big slowdown in restaurant spending in the first half of 2024. But by the time you start getting all the bad numbers in, those stocks will have already bottomed and started moving up. And so people will say, what? How are these stocks reporting bad earnings and yet their stock prices are going up? It's going to blow people's mind. It happens all the time in the market. And on the flip side, you have these stocks reporting good earnings, the stock price is going down, and people are like, how? Why is the stock going down? It's already been hammered so much. The earnings are fine. It might be pricing in something that you haven't seen yet that's coming in 6 months, 9 months from now, a few quarters from now, okay? So just, food for thought there. I think is very important, okay? And I appreciate his thoughts. BLS, by the way, Bureau of Labor Statistics, if anybody's curious. Alrighty, next one up here. Evercore founder. Hard for markets to move higher until more clarity on short-term headwinds.
Strikes in this looming shutdown. Evercore founder and senior chairman Roger Altman. Roger, good morning. Good to have you.
Hey, Carl. Nice to see you.
Eunice told us about China. We're watching the strikes. We're watching potentially for this shutdown. Are the markets incapable of handling all of these boiling pots?
Well, it's hard to be sure about that, but let's step back a bit. The word I would use to describe the U.S. economy this year, as you said, has been resilient. Through the first 9 months, it's just performed better, for example, in terms of growth, than most people expected at the beginning of the year or partway through the year. Real growth for the second quarter was 2.4%. Many people think the figure for this current quarter, just about to end, will be even higher than that. And that's remarkable this late in the economic recovery. After all, it started 3 years ago. But now, as Chairman Powell said last week, there have emerged a series of headwinds. You've been talking about them at length this morning. Oil prices, interest rates, resumption of student loan payments, and then some shorter-term ones in terms of the UAW strike and so forth, and the prospect of a shutdown, of course, those 5. And it just seems to me, until there's more clarity on these, especially the short-term ones, would be hard for markets to move ahead, and they'll probably put downward pressure on the U.S. economy so that the fourth quarter, the one we're about to start, probably going to come in much lower than the last couple, maybe around 1%, not a little too soon to tell, but lower.
Are there policy responses to any of these troubles, Roger? I mean, what more can we spend out of the SPR? Can Biden do anything of note in Detroit this week?
Well, in terms of oil prices, Carl, I'm sure that they're going to work hard, perhaps in the context of these negotiations between Saudi Arabia and Israel over a diplomatic agreement and resumption of diplomatic relations, to see if there could be some increased, at least temporary.
Jeez, Lucid is down to $5 now at this point in time. $5. I don't know what's more shocking, CarMax at $78 or Lucid at $5. And you guys know my stance on Lucid, right? I've said it about a million times over this past 12 to 18 months. My stance on Lucid is that company's in a very poor position. At the end of the day, is somebody going to buy a Lucid over a Model S or Model X? The answer to that is no, okay? I don't know one person that would rather have a Lucid over a Model S or a Model X. And also the Model S and Model X are better vehicles priced a lot more appropriately than certainly one of those Lucid is, right? Why would you take a risk on a Lucid, a company you never heard of, and pay a huge substantial fee more than you would for Tesla, right? That just doesn't make logical sense. So they just continue to be in a poor place, in my opinion. Like I told you guys a million times, the only EV-related stock I like outside of Tesla is Rivian. Rivian's the only one. I don't personally own any Rivian stock. I do own Amazon stock. Amazon has a major investment in Rivian, so I kind of get some exposure there, but that's really the only other one I like outside of Tesla.
Increased supplies, because after all, the Saudis are asking the United States for security guarantees as part of that deal if the deal were to happen.
NIO could be interesting. It's just I don't trust NIO. One, it's a Chinese stock. I don't trust any Chinese stocks. Second reason in regards to NIO specifically is, I don't live in China, and I just don't really know what the true demand is over there, how they view NIO versus other competitors. There's so many competitors in the EV market over there, and so that's just kind of a hard pass for me.
Now, whether that's possible in terms of some relief on supplies, I really don't know, but I'm sure that the administration is working some angle of that. But look, the main policy that's operating right now from a federal point of view, of course, is monetary policy. And we've all seen that the message from the Fed is higher for much longer. And we're seeing, a 16-year high in the 10-year, 20-plus year highs in mortgage rates and so forth. And it's hard for the economy to continue this level of resilience in the face of that.
Yeah, good point. Good point. No doubt about that. And so, to finish out thoughts on that one, at the end of the day, the headline, hard for markets to move higher until clarity on short-term headwinds. I think the biggest headwind we have right now is I think there's really true fear stepping in this market about the economy in 2024. And I believe that's what you're seeing at this point in time, and that's why you're seeing so many stocks at multi-year lows, multi-decade lows, is I believe big money is looking out there and they're very fearful of Fed lags catching up to us in 2024. And I believe that's why you're seeing a lot of these stocks just continue to sell off and get hammered day after day after day after day, right? And it's not really the top tier stocks, because a lot of people look at those and are like, those ones are going to be just fine in this whole situation. But it's some of the what is seen as like weaker names. And so I believe we've got to start to see some economic damage at some point in time. And I believe that's when the market can kind of, or at least a lot of those stocks can start to kind of form out a bottoming formation and actually start to go higher. I know it sounds crazy, like when you're already seeing weakness, but that's what happens in these situations. It's just, things get priced in way in the future, and on the flip side, they get priced way in the future again, okay? All right, next one up here. The fiscal spending has been out of control. This gentleman's going to make some points about the only reason the U.S. economy has really been holding up well is because all this fiscal spending. This is intriguing.
Bashir, it's great to speak with you today. And I think we start the conversation right there. When we talk about this mini miracle, what are we talking about? Why is it fleeting?
Well, I think that first we have to acknowledge the fact that at this time last year, most economists for the first time in history were predicting that America would have a recession. Why I say first time in history is because economists have never predicted a recession as a consensus. So we had that prediction at this time last year. Instead, what we ended up with was economic growth, which in this quarter could top 3%. And we have never had a period in history where the gap between the consensus and in terms of what's turned out to be, as far as economic performance is concerned of America, has been this large. So first, let's acknowledge that we've had something really nothing short of a mini economic miracle as far as America is concerned. But if you look at the reasons why that's happened, a lot of those reasons may really be fleeting. The biggest one, of course, has to do with the massive fiscal stimulus, which has been discussed a lot, that no one anticipated that the fiscal stimulus would be so huge. And then, of course, the consumer has ended up being much more resilient here in America.
All right, hold your horses before we go any further here, okay? He's talking about fiscal stimulus, right? And here's what I can tell you about fiscal stimulus. We got a lot coming for years to go in the future. I mean, when you think about the infrastructure plans, it's a lot. And from what I heard, a lot hasn't even been deployed yet. And that's kind of an intriguing thought process to have to go through. The Inflation Reduction Act and all those sorts of things, and all those, the massive plans to fix roads and highways and railroads and all of the stuff, airports. We still got a lot of that spending coming over the next many years, okay? And so it's not like this is just like, oh, they deployed money in 2023, that's it. No, that's not the way this works. And like I said, from what I heard, a lot of the money hasn't even been remotely close to deployed yet. We're actually going to see a lot more of that in future years, right? Which kind of makes you think, does the government, I always kind of think about little conspiracy theories here and there, right? And it's almost like a little conspiracy theory I have where, okay, the government wants to spend a ton on infrastructure. We're going to need a ton of workers for that, right? Well, it's definitely not easy to get workers right now, I can tell you that much. So where do you get workers from? Well, there's a few ways. You could let a lot more people in the country. That's one way of getting more workers, right? Another way of getting more workers would be a scenario where unemployment goes up, right? And then people need jobs. And if people need jobs and, a government construction job that's paying $60K a year, oh gosh, you're going to take that job, right? So, I don't know, man. Just some things I consider and think about.
Europe or Japan, where a lot of the excess savings are still there. But in America, they really run down the excess savings, and that has given a big lift to the economy out here.
Yeah, we're Americans, man. We spend money. What can we say about that, man? That's the American dream. Spend the money.
Raises the question, and to be clear, there's always...
You can't take it with you. You might as well spend it, right?
Typically a divide between forecasts and reality when it comes to the economy. But the fact that divide's been so wide this time around, does it mean that the economic modeling has to be thought about differently, done differently?
In some ways, yes, because I think that what a lot of us have not taken into account is how the financing structure has shifted in America. What do I mean by that? Well, a lot of finance...
I don't like the way you keep saying America. I don't like that. I don't like that, man.
Now is either in the private market...
Getting offended fast.
Or, of course, as far as the consumer is concerned, it's much more locked into long-term financing out there. So, in fact, as someone put it, that the American consumer now finances long and yet invests short, with so much in short-term deposits. But if you just look at the whole structure out here, which is that it takes much longer, I think, for monetary policy to have an effect under this structure. So typically it would take about 18 months when you would start to see monetary policy have a serious effect. This time the monetary policy tightening has been even greater. But I think the effect could be even longer given just how much is now done in the private markets and how much of this is long-term financing. So some of that...
GDP percent change over time. This right here was the recession. They didn't want to call it recession. Yeah, I wish we would have got that done. That would have given a better feeling. Now, at least the people would have been talking about, instead of like a recession's coming, people would have been talking about a double dip recession. If we would have just called this, which was an actual recession, based upon how we've always defined a recession, 2 quarters of negative GDP, then we could at least be talking about, oh, we're thinking about double dip recession. That would have been an interesting convo, at least, rather than still looking for the first recession.
Is that. Having said that, I think that I'd be a bit cautious from here onwards, because I just feel this fiscal spending has been out of control. We have never seen fiscal spending of this magnitude in America. And I think that is bound to taper from here. And that, I think, could be a big drag for economic growth going ahead, especially because this time interest rates are unlikely to come down much when economic growth weakens. So you're not going to have much of a counter effect to this tapering off fiscal stimulus over the next few quarters.
Are you arguing, Ruchir? Would you go so far as to argue that the reshoring effort and the cost associated with it was a mistake?
Yeah, I think that in terms of just what's being spent is a mistake, Carl. Let me just consider this, that America ran budget deficits of about 3% of GDP for much of the last decade. That was in line with other developed countries. What are we doing here now? We are running a fiscal deficit or a budget deficit now of 6% of GDP. It's running over 8% for this year, but the trend rate is about 6% for the next few years, the CBO projects. That is a staggering number which no other developed country is currently running. So we have really taken our privilege as being the world's reserve currency to another level here now by running fiscal deficits and expecting the world to finance that for a long period of time. And it's quite possible the bond market, after a long time, is beginning to get worried about that. And so therefore you're seeing higher real rates across the curve.
Yeah, I think he brings up a great point there. I just think I got to take away his privilege of saying America, because I don't like that. It sounds like he's cussing us out at the same time. So here's my perspective. It has been a bad time for the government to be spending heavy, a horrible time for the government to be spending heavy, just to be quite honest, because unemployment's so low right now. You want the government to spend like crazy when you have a recession. Like that's when the time you want the government to really step up and spend heavily and do all these different infrastructure packages and things like that, because that's the moment where it's like, oh, we need jobs. We need to get the economy going, right? It's not good when, because think about it. Imagine you live in a city and the government's like, we need an extra 10,000 workers here. And you're like, oh, like unemployment's already super low here. So then all of a sudden there has to be a battle for wages, right? Between the government trying to get another 10,000 workers from your city versus companies that are looking to hire folks. Wages have to go up, causes inflation, right? And it puts even more pressure on inflationary, problems. So that's kind of something I think about as well. And I think he brought up some good points. You just can't say America anymore. All right, next one up here. Amazon steps up AI arms race with a $4 billion investment in Anthropic. What's going on here?
Anthropic, as it looks to stake a claim in the AI arms race. Deirdre Bose is watching that today for Tech Check. Hi, Dee.
So, Carl, this is how big tech maintains its lead in artificial intelligence. Deals with the most promising startups in the space alongside their own efforts. This deal, though, it touches on both of those aims. Anthropic will get the compute power that Amazon's cloud business provides that it so badly needs. That stuff is expensive. Amazon gets a buzzy customer for its custom AI chips and a minority stake in one of the earliest applications of generative AI. Now, Anthropic is known as the OpenAI rival. It was co-founded by veterans of that company, and it's seen as one of the hottest startups in the space currently. This isn't, however, the exclusive partnership that Microsoft and OpenAI inked earlier this year. Anthropic already has a partnership with and investment from Google. Now, at $4 billion, up to $4 billion from Amazon. This one, it would be more substantial, but we don't know the size of the stake that Amazon is getting. We also don't know how much Anthropic will actually rely on Amazon's in-house silicon versus NVIDIA's GPUs, which are still seen far and away as the best AI chips on the market. It is also unclear whether this deal will give Amazon the so-called AI halo effect that Wall Street seems.
So my guess right off the bat is it's going to be a major investment in terms of Amazon's going to have a considerable let's call it ownership of the company. And my guess is somewhere between, 10% on the low end to maybe 30% on the high end ownership of the company. That's my guess, okay? I have no inside information. That's just my guess in regards to that. And at the end of the day, I think it could potentially be a smart move for this company because we know AWS runs the world and you got to have a very close relationship with them. It's a very intelligent decision.
Bestowed on Microsoft and Google. While they have released chatbots to consumers, that would be ChatGPT and Bard, Amazon has taken a different approach. It's focusing on developers through AI tools like Bedrock and promising greater flexibility by not being confined by a single provider. They have said that they firmly believe there will not be one model to rule them all. So in that sense, guys, this latest deal might be seen as maybe a slight shift in that strategy because it does bring Anthropic's chatbot cloud and its technology deeper into Amazon products across the business, guys. So it's a big deal with a lot of different implications here. But of course, Anthropic, probably a name that you guys are familiar with our audience with. It's sort of one of the buzziest AI startups after OpenAI.
Yeah, Anthropic's actually been on closing bell overtime in recent weeks, too. But at $4 billion, Deirdre, this would represent the largest known piece of corporate deal making directly related to AWS. I wonder, at a time where Amazon is under regulatory scrutiny right now, and we've had all these reports that a big antitrust, move by investigation by the FTC could be imminent. The fact that they did an investment like this that's so expansive, is it reflective of that environment versus, say, just acquiring the company outright?
Yeah, and I think you could make that argument with Microsoft and OpenAI as well. That wasn't a straight up acquisition, but it was an exclusive partnership. That deal saw $13 billion. This is $4 billion. So what it tells you is that deals are still being done, but maybe in a more creative way. On that point, too, Morgan, it's notable that they didn't tell us, neither company told us how much of a stake that Amazon is getting. If it was, larger than, say, 10%, maybe the antitrust regulators would have perked up and said, hold on a second, what's going on? But what they're really focused on is the core business. The FTC is looking at Amazon's core of e-commerce and the Prime ecosystem, how that is maybe locking customers in, how maybe they're getting an unfair advantage. But it feels like artificial intelligence is sort of a zone where they know they have to get deals done, so they're doing it creatively. And it's also, by the way, acceptable, it seems, for Wall Street, right? We've been in this cost-cutting mode. Amazon has seen layoffs. It's been trying to achieve greater efficiency. But artificial intelligence is kind of like this hands-off zone for Wall Street because they've got to develop the new technology. They want to be seen as the forefront. You see, all of big tech is doing this.
100%. Yeah. So I think it's a good move by Amazon. We'll see where the technology goes over time, but I can tell you Amazon's got some very, very intelligent folks. And if they're making an investment in you, it's a pretty good probability it's going to be very, very successful over time. So, yeah, appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed. If you're looking to apply to join my private group, then check out the pinned comment down there, fill out an application, and we can see if we can get you in there this week. That will be pinned comment. Much love and have a great day.